Welcome to TMS Insights early October 23, and Ben, September didn't go the way we wanted it for the markets. It was down about 3.5% here. We've had a reasonable year overall, but it's come back a fair way, the equity markets.
Yeah, it's frustrating because you sort of felt like this interest rate story had hopefully been put behind us, and I think what's happened recently has wrong-footed a lot of the participants in the market.
Yeah.
We've seen, we'll put up a chart here again, which is the 10-year bond yield, and this is the Australian 10-year bond yield, but it's not unique to Australia. And in fact, if anything, in America, it's been sort of what's led the charge. But in every bond market around the world, we've seen this little breakout of yield. So bond prices falling, yields moving higher. And as we saw in 2022, when you get bond prices moving around like this, it drags down asset prices until you start to see some stabilisation, and then that flows through in turn.
And that was mid-22, June. We saw the really heavy selling in equities. It bounced back. And then, as you're talking about the bond price and yield movements, it's a bit stop-start, isn't it? It's almost like it gets a bit of a thematic and it grabs the market's hold for a period of time. And, you know, as we're speaking now on the Thursday, we saw an easing in that pressure overnight.
Yes.
Which has been for a couple of weeks now, pretty intense.
I mean, if you think the Aussie 10-year was at like 3.4 a couple of months ago, it's now at 4.7.
Yeah.
So it's been a big move again.
Yeah.
And
it's a massive move.
Yeah.
And they're hard to particularly forecast. They get momentum of their own, don't they? And it did, as we said, just pause overnight. So it might be that it's done because... and let's go into those themes. I mean, you mentioned the reasons why, Ben, but it really comes back to a view, started sort of with central banks, the markets then buying the view that rates are going to be higher for longer. Yep.
Look, as you said, it's impossible to know, has the bond market overshot itself? Is there further to go? Does it stabilise from here? Because the things that will drive it from this point are completely impossible to predict. Yeah. But the thing that seems to have sparked this has been stronger than expected employment data in America still, a much higher move in the oil price, and some of the Fed governors coming out again and jawboning down expectations of rate cuts anytime soon. And it feels like it's a combination of these things has seen this breakout in the bond market, which has pulled down the equity market in the short term.
And they can have more to do where the participants were situated before that, because they've got to adjust.
Yeah.
You know, if you were buying the view, for example, that rate cuts were due in the end of this year, and you've got to change that, well, you've got to make market moves that reverse that thinking, don't you? So
definitely.
And that's where we think that even though we know there is supply issues being dealt with and demand is easing back, it's probably a time when bond yields should be going down, not up.
Yeah.
But it's more about the participants and what they're doing.
Yeah, and it's about, like, you know, I think every fundy that I follow and listen to really felt that this was rear mirror sort of stuff, that the bond market had done its thing and we were going back to a more normal environment. And I think it's wrong-footed people. You know, it's come out of, sort of sparked out of nowhere after a year where we really have seen bond yields sort of quite erratic, but in a trading zone. Yeah. And during that year, the equity market has got back on its feet and is back doing its thing. Yeah. And then you've seen this other spark of volatility, and that's dragged down asset prices. It won't last forever. I think for me is an important thing. You know, maybe last night was the start of the market sensing
it's done its bit.
It's done its thing.
Yeah. And the yield curve will probably be quite a flat one, I think, going forward. So that
looks that way.
Yeah, and then you can get about your business then. And where it means ASX 200 about 6,900, Ben, is a reasonable level. You can now see value that wasn't there a month ago. So there's an upside. And there's a range of stocks that are of interest. We might talk about a couple that have actually reported, the ones out of cycle, and we obviously follow Soul Patts and Brickworks, who are July year ends, and Premier Investments, a few of them. Yeah. But you know, it was pretty interesting to read that and listen to the Brickworks result, and particularly that table they showed for the first time on their implied asset value. Yeah.
So we another chart we'll put in here is because it was a new one that came through in their deck that we haven't seen before, and I think it actually does speak to the fact that both these companies are giving the market, they're stepping up communication with the market, they're giving more transparency into what they're doing, which we have, I would say...
No, they were terribly, I remember in the old days, they were the terrific companies still, but bad communicators.
Run like a family business as opposed to a public company. Yes. And so this Brickworks chart that we're putting up here, what it shows you is firstly, Soul Patts and Brickworks use incredibly conservative accounting metrics to value their assets. Huge banks of land valued at what they pay for the land.
In 1962 or something.
Exactly. Yeah. And so what Brickies is showing here is what the value of the Soul Patts portfolio is worth per Brickworks share, what the value of the incredible industrial property trust is worth, less some tax, some bits here and there. And what we see is there's now an inferred asset backing of around
$37.47. And of that, $20 is basically their listed investments, which is largely Soul Pattinson. So, and the other part that's really important is that Goodman Property Trust, which has been unlocking a lot of value for them. So to see a number like that, so they're trading around $25 at the moment. It gives you a really clear read on that company. Now, we're not suggesting it goes up to that asset value here and now, but we want two things when we invest: upside and protection on the downside. And you're getting it when you're buying things with tangible value like that.
Absolutely. I mean, you're right. Like, I can't see it trading at its inferred asset backing, but I know if we're buying at a 40% discount to that, there's not a lot that can go wrong, and there is upside. And I think a knock-on question for that is Soul Patts and Brickies both got sold off quite heavily on their results, and I saw Todd Barlow get interviewed, and he was just wringing his head saying that, we just don't get it. But there's a bit of noise around the operating results. It's not really reflective of how we value the business.
Well, when you look at that table and you consider the building materials division on the headline numbers was down 50% on profit, you'd do anything but buy it, but we more think it's a buy because it's immaterial for the operating value of the company. So
it's like a McDonald's that is a property business, but everyone thinks of it as a fast food business. And there'll be periods where the demand for the fast food goes up and down, but really it's the properties that you're worrying about when you're looking at what you should pay.
Absolutely. So looking out now, Ben, we're in October. October doesn't give us a lot of information. We get a high focus on macro into the end of the year now. We get bank reporting season in November, and we get a rush of dividends coming in right now. There's a lot of dividends coming into the market overall and to clients' portfolios at the moment. So what are the other things we should be looking at?
Well, I think just that, September, we've spoken about bond yields. It also historically is a bit of a nasty month in the market, and October is normally one of the better months, but then we round into this sort of what is normally a very good period to be invested, which is running into that December period. And, a lot of the analysts sort of think that potentially that is because dividends hit bank accounts and they get reinvested. So you've got a stronger underlying buyer than normal. There is, I would say, the bank's earnings season coming up. I guess there'll be some interest there. We're probably we've then got the AGM season coming up as well, and I think that's the bigger thing leading into Christmas.
This is the thing, Ben. I think we're going to move from this macro chat straight back to earnings by the end of this month.
Big time.
And that'll be what AGM updates will be happening. Some will be doing okay. We know we came off a good reporting season. What's next for earnings?
So that's going to be, it's an interesting environment at the moment because I think if you look at the earnings results, it was probably toward the end of last financial year that things were really starting to tighten a bit. The 12 interest rate rises in 14 months, it was starting to turn the screws. So it's how businesses are dealing with that and trading updates that we're going to get through the AGM season will be key. But look, it's I think the setup is actually pretty good from this point
for a run into Christmas, December rally, which we all enjoy and we happen most of the time, like you said. So,
and do you see Aussie 10 years at 4.7, like it feels high.
Yeah,
I mean,
it's
does it keep going?
Contrary to the slower growth that we're seeing globally, isn't it? Really?
It is,
so,
yeah.
But
hard to see it going to 5. Maybe it could happen, but I struggle to see that.
Yeah.
It's sort of saying a few more rate hikes and then on hold for a very long period of time is what the market's saying.
Probably overplaying fear, I think, too, and that's which is interesting. So it's got a fair bit to run.
We'll see. Time will tell.
So it'll certainly tell. But that's all we've got time for today. We'll be back in another month with another TMS Insights.